Hi everybody, welcome to today's lecture in which we have two topics. We're going to derive the weighted average cost of capital. We talk about what it is and why it is important. And then in the second part, we use the weighted average cost of capital to determine the value of a firm, the value of a company. This is also our agenda. We start with the weighted average cost of capital because we need it for the firm value, and then firm value, second chapter. All right. What is the main question here? What's the idea? The question from a company's perspective could be all the capital here we have on our balance sheet on the liability side. What does it actually cost us? What's the price for that? The price for money is the interest rate or the expected return we have to achieve or we have to pay. And the answer to that question is, if we go through this expression step by step, the weighted average cost of capital. So let's go through it step by step. Weighted average cost of capital. Cost of capital is typically a percentage number. An interest rate if you have a bank loan, an expected return if you are a stockholder, and so on and so forth. A coupon if you are a bondholder. And that means we will come up at the end with one number, a percentage number, cost of capital. We will have an average because, as you can see, we have different types of capital, equity and debt. And within equity and debt, maybe different types of equity and debt. And the prices, the percentage numbers could be different. So we need to calculate an average. And here in this chart, I drew the equity and the debt boxes equally large. But it could be that you have more debt or more equity, and therefore it's not a simple average we have to calculate, but a weighted average, weighted by the fraction of debt and equity. That's exactly what it is, weighted average cost of capital. Now let's do it. Let's jump here to this animation, and let's check out how to do it. Okay, we are interested in the weighted average cost of capital, and the liability side looks like this. We have equity and we have debt. Now what we need to do is we need the cost and the relative size of this equity block. Okay. The cost of this equity block is RE, return on equity or expected return on equity of our company. If we are BASF, this would be expected return BASF. If we are Siemens, expected return Siemens stock. Okay. Relative size. Total value of equity divided by total value of debt plus equity. So in percentage, how much equity do we have as a fraction of total capital? The abbreviations here are E for value of equity and D for total value of debt. So D plus E is the total value of all capital we have. Now we do exactly the same thing here. We need the cost and relative size also of this block. The cost of this block is called RD, the return on debt, which could be a coupon for a bond, which could be the interest rate on a bank loan. So we have cost RD here. Relative size, D divided by total capital. So it looks similar to the fraction we have above. The only thing that is different, in the denominator we now have D, the total value of debt, so the same abbreviations apply here. Okay, how to calculate the weighted average cost of capital? We have cost and size of the upper block, the equity block. We add cost and size of the lower block, the debt block, and we have our weighted average cost of capital. Okay, to be more precise, let's look at the formula. So if we multiply the fraction of equity with the cost of equity, we have relative size times cost. We do this for debt and equity, and the only thing we have to do now is we have to add these two numbers up, and we are there. We are at the weighted average cost of capital. We calculated our average cost of total capital as a percentage number. Good. You also have this on your slides, so you can look at the formula here and here. And let's now look at the input factors. So what do we need? we have this in the first column here. We need different numbers. We need the cost of debt, RD. RD. We need the value or the total value of debt, D, the cost of equity and the cost of debt. So this is what we need. There are two ways of finding these numbers in practice. You could check out market values or you could look at book values. Let me give you a very important disclaimer. Market values are always better. You should only use book values if and only if market values are not available. If you have the choice, the market value is more precise. It's the better measure. Why is this the case? Let's think of any company. Let's pick Adidas. Let's say you're interested at Adidas book value of debt. The latest number you can find is in the latest annual report. But let's say it's, I don't know, January or February of, let's say, 2022. What is the latest report you can find? The latest report is the report from 2020, because the 2021 report will be published maybe in March or April. So the number you find is more than a year old. And if you think about stock prices, how much they fluctuate from day to day, and if you think about bond prices, which are value of debt, you can be pretty sure that this old number is not correct anymore. If you have no other way of finding it, you can use it, but only if no market values exist. Book values are a snapshot of one point in time, end of the year, and they are not very frequently updated. So what we will do now in this lecture, we go through all the market value methods and all the book value methods and calculate with an example, Trumpf, the weighted average cost of capital. And we learn how to do that. And since the market value methods are so much better, we start with them. All right, let's go through this list and let's start with the market value of debt, D. This is the variable we are interested here. Side note, clearly the market value can only be determined if the debt is traded on some market. This is the case if the company has issued bonds. We know what bonds are, we know that you can issue those, and we also know that this is more likely for larger corporations. So market value of debt should be easy to obtain for Siemens, Adidas, any DAX company, but it should be more difficult for smaller companies where no bond is traded on the bond exchange. Now, if there are bonds, what is the market value of debt? The answer is, it is the number, the euro amount, or in any currency, US dollar amount, you would need to buy all the bonds available, because that's the market price for all the bonds. And this is the market value of this company's debt. The market value is the sum of the current bond price, B0, multiplied by the nominal values. You remember the bond price is always given in percentage of the nominal value. If you're interested in a euro amount, it is bond price times nominal value. So you can see here in this blue box, this is how you would calculate the market value of debt. You would need all outstanding bonds and you need to take the price and multiply it with the market value, the nominal value. I have a quick example here. Let's say some random company has exactly 2 bonds outstanding. Bond 1 has a nominal value of 150 million, bond 2 of 50 million, and the current prices are 102.5% of bond 1 and 106% of bond 2. So what you would do to find today's market value of debt is you take the bond price of bond 1, multiply it with the nominal value, plus the price of bond 2, multiplied by its nominal value, and you would find today's value of this company's debt is 206.75 million euros. That's the idea here. Okay, I think that makes sense. Now, the return on debt, the cost. So this is the size, but now let's check out the cost of debt. Same logic, only for companies that have traded debt. Same logic, only larger companies. So what would we do? If you think about buying a bond, you remember the yield to maturity. The yield to maturity tells us if we are buying this bond today, what is the annual return we as an investor are achieving with this investment. Now, if we flip the coin, so the other side of that same coin is, if we are in the company and we take the company's perspective, if we were to issue a new bond today, what is the return we would have to pay to the bond investor for him or her to be willing to invest in our company? And the answer is the yield to maturity, because people are buying our already existing bonds, and this is the return they are getting. If we were to issue new bonds, this would be the return they are at least requiring, otherwise they would not invest. So the yield to maturity is the cost of debt. And we have to take the average yield to maturity of all outstanding bonds, the weighted average weighted by nominal value. So the definition is the cost of debt is calculated as the weighted average of the current yield to maturity of all outstanding bonds. The formula here is given again in the blue box. So what you do is you take today's price times nominal value times yield to maturity, and you divide it by total value of all outstanding debt, price today times nominal value. So this number here in the denominator is the exact same number as we calculated here. You can see it's the same formula. It's just in a denominator. And if we look at the example, how would we do it? We would take the bond price here of bond 1, 102.5%, multiplied by the nominal value, multiplied by the yield to maturity, which is given, then add price of bond 2 times nominal value of bond 2 times yield to maturity of bond 2, and divide it by 206.75 million, the market value of debt. And in this example, we would find the average yield to maturity here is 2.24%. Let's just do a quick sanity check. Does this number make sense? We said, okay, the yield to maturity of bond 1 here is 2.5. The yield to maturity of bond 2 is 1.5. So the average has to be somewhere in between these two numbers. Okay. And the average has to be closer to the yield to maturity of bond 1. Why? Because the nominal value times price is much higher. So this bond should have a higher weight. This is similar to you having, let's say, two bank loans. One bank loan you took out 50 euros, just 50 euros, and let's say you pay 1% interest, and another bank loan where you took out 10,000 euros and you pay 10% interest. The average interest rate you're paying on your total debt, 10,050 euros, should be close to 10%, because the big loan should have a higher weight. And this is exactly what we are doing here. Okay, market value of cost of debt. So we have market value of debt and market value of cost of debt. Now let's move to equity. Equity value is very easy. The only thing we have to do is we have to check out, and we can find this online, we can also find it in the annual report, number of outstanding shares, and we multiply that by price per share. Then we know how much would we need to spend if we were to buy all the shares, all the stocks of a company. So you could Google outstanding shares BASF, you would find 918 million. Price of BASF, I don't know, maybe 50 euros. So if you were to buy all BASF shares, you need 50 euros times 918 million. That's, yeah, I can't do the math in my head, but something around 5 billion. Here, example Daimler. I have the share price at the end of the year 2018. This is when I created this example. And you can see the share price was 45.91. And the number of outstanding shares, you can see it here, was about 1 billion. So 1,068,800,000 shares. So the total value of equity was 49.1 billion if you multiply these two numbers. That's how you would do it. All right, so let's go back to our overview slide. We have now cost of debt, total value of debt, okay, and total value of equity. So this one, and the last one. Missing is this one, cost of equity. And we see something we know. It says CAPM. The CAPM will help us to determine the cost of equity. You might remember the CAPM formula. It says the expected return of a company is RF plus beta times RM minus RF. And the expected return is exactly the cost of equity. This is what we're looking for. So let's check out how we would do it. Here we go. We use the CAPM formula to determine the cost of equity. We use the security market line. So what we would need to do is we would need to find the beta of the company. We would need to estimate the market return. We would need to estimate the risk-free return. And then we could do the calculation based on this formula here, based on the CAPM formula. Let's go to our animated PowerPoint. Here where we calculated the weighted average cost of capital. And let's jump to this next example. So let's say we are interested in the cost of equity of Trumpf. And we need the expected market return, we need RF, and we need beta. Because we are interested in this formula here. Let's say we use as market the German stock market index DAX. It's not the best market proxy. We could use a bigger index, but just for the sake of this example, let's use the DAX. The average return since inception of the DAX was about 6%. So let's use 6% as market return. I checked out the risk-free return at the moment. It is very low. Actually, German government bonds give you a negative return. So let's use 0% because a negative risk-free return in the CAPM doesn't make too much sense because you could always just keep the money under your pillow and then you get 0. Okay. And the beta of Trumpf, I looked it up in the NYU STAR database, the New York University STAR database for it's a database for betas and many other things. And here I just checked out Trumpf beta 1.17. So what we would have to do is let's draw our securities market line, expected return on the y-axis, beta on the x-axis, and we have 2 points, 0% RF, DAX gives us 6%. We know the beta of DAX, 1. The beta of the market is always 1. So now we can draw our securities market line, a straight line that goes through 0 and through the DAX. For Trumpf, we have the beta 1.17. That means Trumpf is located here at that point. And this point corresponds to an expected return of 7.02%. So here you have the formula. 0 plus 1.17 times 6 is 7.02%. And this is the cost of equity of Trumpf. And we can use this now to calculate the weighted average cost of capital. Okay. Now, let's say for some reason market values are not available. And actually for Trumpf, market values are not available because I checked Trumpf has no bonds outstanding. What could we do? We would love to do it with the market value method, but sometimes it's not possible. So let's use the book value method here in this example. Book values can be found in the balance sheet and the income statement or profit and loss statement in the annual report of any company. The big disadvantage is they are only produced at the end of the fiscal year. So they are outdated. By the time I created that slide here, it was February 12th in 2020. The only financial statement available for Trumpf was 2018's annual statement, which means the number is more than a year old. That's the big disadvantage. The advantage is clearly it's easier. You just have to take the annual report. I'm doing this like a book, but it's actually online. You just go online, you download it, and you just look up the number. The value of debt can be found directly in the balance sheet. And if we want to calculate the cost of debt, what we do is we take the profit and loss statement. There's a line item that says interest expenses, total interest expenses. So what is the amount in interest we paid over the year? And we divide this by total value of debt, and then we have the average interest rate we pay on our debt. So let's do it for Trumpf. Here is the balance sheet and the profit and loss statement. And you can see actually here, this is the total value of debt, 877 million. The numbers are in thousands, so 877 million. And here's the profit and loss statement. It says interest expenses in total 22,437,000. So the cost of debt can be calculated as total interest paid divided by total debt. And in this case, it's 2.56%. That's the average interest rate. Yeah. Okay, so this could be applied just in case you don't have access to market values. What about, okay, let's go back to the overview. What about book values of equity and cost of equity? Cost of equity, there is no book value. There you have to use the CAPM. You can calculate the beta based on different measures, not only stock prices. We didn't do this because it's beyond this class, but you can look up in databases such as New York University's database betas. So there is no way around. You have to use the CAPM. And book value of equity, okay, you can check out the balance sheet as well. You can see here for Trumpf, it would be 1.876 billion euros. You just have a line item in the balance sheet that says total equity. All right, now we are done for Trumpf at least. So we needed cost of debt. We found it, 2.56, book value method. Not so cool. Total value of debt, 877 million. Okay, we found it. Cost of equity is 7.02%. We found it using the CAPM. Total value of equity, 1.876 billion. Trumpf is not listed. That's why we're using the book value. And if we plug in these numbers in the weighted average cost of capital formula, we find Trumpf has weighted average cost of capital of 5.6%. Why is this so important? Why all this effort to come up with this 5.6%? What can we use this number for? If you think of an investment decision where, you say, let's calculate the NPV. Let's calculate the present value. You always use an interest rate to discount future payments. And so far, maybe you didn't think about where does this interest rate come from? What is this interest rate? And actually what you would use is the weighted average cost of capital. This number is an input factor for every investment decision you take. Weighted average cost of capital. And it's an input factor for calculating firm values. That's why we had to cover the weighted average cost of capital chapter first, because now we will see how we can apply it to calculate the value of a firm. Okay, so the method we're going to apply to end up with the value of a firm is called discounted cash flow method. And it's very descriptive because it has already in the title what we're going to do. We're going to discount some cash flows. But, not only some cash flows, there's some work required here. And we have to do this work step by step, and the steps are outlined here. The discounted cash flow method actually has 5 steps. Let's go through them here on this overview sheet first, and then deep dive into them on the next couple of slides. The first step is you need to forecast the free cash flow based on historical data. Now, what is the free cash flow? We will learn this in a second, but it already highlights an important point. We need as an input factor cash flows. Cash flows are typically seen on a bank account. If you are interested in your cash flow, you go to your online banking and you can see all the cash inflows, all the cash outflows on your bank account. Now, as an investor of Siemens, BASF, any company, we cannot call the company and say, hey, can you please send us your bank account statements? We are interested in the cash flows. The only information we have is the information that is published in the annual report. So balance sheet, income and statement, maybe some other statements, but we have no access to cash flows. The solution to this problem is we somehow have to use this accounting numbers, these book values, and we have to transform them so we get an understanding about the cash inflows and cash outflows on the company's bank account, and to get an understanding about the free cash flows, the cash flows that are available to us as potential investors, the cash flows that could be used to pay interest, or the cash flow that could be used to pay a dividend if we are equity investor. Okay, but we somehow need to forecast that. In a second step, we have to think about the cash flow growth, because most companies have as a goal profit maximization, and actually they try to have more profit each year. So there's some growth in the company. The company tries to expand and to grow. And because of that, we have to forecast, what do we think about the future cash flows? Are they also growing? And if so, by what rate? If we have that, we have done the majority of work already. We know cash flows and we know cash flow growth. Step 3 and 4, I already checked it. Why? Because calculate the cost of equity and cost of debt. We know how to do that from the previous chapter here. Why do we need cost of equity and cost of debt? Because step 4 is calculate the weighted average cost of capital. Okay, also checked. We know how to do that. And the last step is now discount all future free cash flows the company is producing based on our estimate to today's value, and add all the numbers up, and then you have the firm value. So basically the value of a company is today's value of all the profits, simplified now, I'm speaking simplified, of all the future profits they are making. So that is, I mean, to me as a student, this was a surprising result, because I always thought maybe the value of the company is the total value of the balance sheet. But that's actually not true. If this were true, it would be super sad, because then the company, you know what they should do? They should just sell all their assets and that's it. If this were the company's value. The company value is higher than that, because they are doing something with those assets. They are creating value. They are producing products and selling products or services. And the total value of what they are doing should be more than just the value of the machines and buildings and so on the balance sheet. Otherwise, there would be no need to put all this effort in to go to work every day if the total value of what you're doing is just the value of the balance sheet. Then stop doing it and sell all the machines, and that's it. Okay, so that's how we do it. Now let's start with step 1. You can see step 1, we need 6 slides to understand the first step. Free cash flow, slide 1 of 6. So the question is, how can we estimate free cash flows? We can estimate free cash flows from information about the operating cash flow, about everything we can see in the income statement. So what do we see in the income statement? We see sales, revenues. Revenues typically are cash inflows. So we can estimate how much money is coming in by looking at revenues. The only problem is we have to understand quantities and prices. How much did they sell? At what price? I think that's okay. That this information is there. And when do customers pay? It could be that on the balance sheet or on the income statement there's a revenue, but customers pay next period. Then there wouldn't be a cash inflow. So we have to account for that. Then what else is in the operating cash flow? We have raw materials. So money we as a company spend for input factors such as, raw materials, energy, stuff like this. You can find this also in the profit and loss statement. The question here is quantities and prices. And when do we pay as a company? Are we buying and we're getting a build, but we have 30 or 90 days to pay, and maybe we pay next period? Or are we paying immediately, because then it's a cash outflow on our bank account? What else? Wages, we have to pay our employees clearly. This is a cash outflow. At the end of every month, money goes from our bank account to the bank accounts of our employees. And there might be other items that produce cash outflows, such as insurance companies. We have to pay our insurance premiums, such as spendings on maintenance for our machines and our buildings, production plants, and so on and so forth. And at the end, we also have tax payments. The tax payment clearly is a cash outflow from our bank account to the government. Okay, what can we see? We can see that changes here result in changes in the current assets or the working capital. And that's good news, because changes in current assets on the balance sheet, in German you would say Umlaufvermögen, we can see this in the balance sheet. And we can calculate the change from one period to another and get an estimate about the cash in or outflow on the company's bank account. Now, the second part, capital expenditures. So maybe the company also spends some money on buildings, on equipment, on production plants, production machines, and so on software. This would also be important to know for us if we try to estimate the cash flows. The question here is prices of those assets and timing of payments. Maybe also replacements during the year. We will talk about this in a second, but it could be, if you just compare the value at the end of year 1 to the value at the end of year 2, could be the same value, but in between maybe something has happened, something was, destroyed and rebuilt, then you wouldn't recognize it. And maybe some, old machines also have been sold, and you have some liquidation or salvage value at termination, and you have to include this in the cash flow. But again, good news, all the changes here result in changes in the fixed assets. In German, you would say Anlagevermögen. And again, this is something we can check in the balance sheet. All right, so this is basically where cash flow estimates come from. Now, free cash flows versus accounting numbers. This is somehow a repetition of what we talked about already, but it's important in a second, so let's talk about it one more time. Cash flows are just cash in and outflows on the bank account. Accounting earnings are not necessarily, and accounting expenses are not in all cases connected to cash flows. It can differ, and it's important for us to understand when it differs. So let's do a simple example here with depreciation. Depreciation means you're distributing the loss of value of a production machine or some production plant or a car, whatever it is, over the lifetime of the asset. So let's say you're buying a new machine for 100,000 euros and you're using it for 4 years. In year 0, you have to pay the machine. You're buying it and you're paying your supplier. So 100,000 flows from your bank account to the supplier's bank account. However, in your accounting numbers, what you would do is you would depreciate the value of this asset over the lifetime of the asset. Let's say you can use it for 4 years and at the end it would have a value of 0. Then what you would do, you would say, okay, every year I'm depreciating it by 25,000. And you could see, every year depreciation 25,000. But this accounting expense, depreciation, is not connected to any cash flow. There's only one point in time where cash is flowing, at the beginning when you buy the machine, and afterwards there's no cash in or outflow, only depreciation. So the accounting earnings can be managed. You could depreciate more or less at the beginning, but the cash flow can't. And cash flows are more important for firm values than the accounting values. Okay, so keep that in mind when we look at the free cash flow now on the next 4 slides. So what is the formula? To calculate free cash flows for year T, for any year T, we use the formula. We take the earnings before interest and taxes. This is EBIT. We subtract tax payments, because tax payments are not on our bank account anymore. That's money that's flowing out. We add depreciation. Why do we add depreciation? I'll tell you in a second. We subtract the change in working capital and we subtract the change in capex. That's the idea. So let's go through this formula step by step. The first part, EBIT minus taxes plus depreciation. What's the idea? EBIT is sales, cash inflow, minus costs of goods sold, cash outflow, minus depreciation, no cash flow. So EBIT is needed to calculate the tax payment. So we take the EBIT, we calculate the tax payment, and we subtract the tax payment. But now we have a problem because in the EBIT, we subtract the depreciation, but we said before on the slide, depreciation is not a cash outflow. So we don't want to include it in our free cash flow calculation. That's why we are adding it back now, plus depreciation, so it cancels each other out. Here in the EBIT, you have minus depreciation. Here you have plus. So in the formula, depreciation drops out. That's why we have to add it back, because we subtract it at the beginning in the EBIT, and now we add it back. Okay, this is the first part. Second part, change in working capital. So change in current assets. Working capital, what are current assets? Inventories, receivables, and payables. Inventories are finished products that are not sold yet, or raw materials, and stuff like this. So everything in the current assets, things that remain in the company for a short period of time. Receivables are products that we already sold, but the customers didn't pay yet. So we are expecting a cash inflow in a short amount of time because we already delivered and sold the product. Customers need to pay. And payables, that's vice versa. So we received some raw material, but we didn't pay yet. So we are expecting a cash outflow in a short period of time. And the idea is now we have to calculate how did working capital change from one period to another as an estimate. How much money did the company spend on raw materials, inventories, and how much money will come in through receivables or flow out through payables? Okay, the working capital is something you have to invest in, maybe at the beginning of a project, and it will be recovered during the life of a project. And typically an increase in working capital, if the change is positive, means cash is flowing out. If the change is negative, cash is flowing in. Why? Let's do an example. Let's say the working capital increases because you have now more raw materials than you used to have. That means you bought more raw materials. That means you paid more raw materials. That means cash was flowing out. Let's say working capital is less than it used to be. How can that be? Let's say, so you have a negative development. Let's say it's less because you have less receivables. How can receivables decrease? Customers pay. Then it's not a receivable anymore. If customers pay, money is flowing in, and that means less working capital means cash inflow. Okay, so we need to check out the balance sheet, and we will do this in the exercise session and calculate the change here. Now, next step, capital expenditure. The question here is, so the headline here is, how much money did the company spend on current assets, on long-term assets such as buildings, machines, land, software, stuff like this? I mean, the logic is simple. You just take the balance sheet and you look up the line item property, plant and equipment in year 1, and you compare it to property, plant and equipment in year 0. And then you have to change. That's the first idea we could have. So let's say buildings, or let's say production machines in year 0, 1 million, in year 1, 2 million. Then we know, aha, they spent 1 million on production machines. Not quite right. You are making one mistake. You are forgetting that between period 0 and period 1, a lot of stuff can happen. So let's use this example here. Let's say a company owns only one building and the book value of the building is 5 million. And this is on the balance sheet in year 0. Then at the beginning of year 1, the building burns down. It's completely destroyed. It has a value of 0. So what the company does is they depreciate the building the value from 5 million to 0. But they need a building, you know, they need to work. So they are buying another building with a value of 5 million and they're spending 5 million on this new building. Then at the end of year 1, if you check the balance sheet, you see a hub building with a value of 5 million. And you might say nothing has happened. At the end of year 0 and at the end of year 1, we have one building with a value of 5 million. So you would forget that it burned down and was rebuilt. And to account for that, what you have to do is you have to check the depreciation. So the change in capital or the capital expenditures, the money spent on long-term assets is calculated as property, plant and equipment, PPE, in year T, minus property, plant and equipment in year T minus 1, plus depreciation. And then you know exactly how much the company spent on long-term assets. All right, that's the capital expenditure part. And then this is the formula. Here I give you the detailed formula. We start with the revenues, we subtract cost of goods sold, we subtract depreciation, we have the EBIT, we subtract tax, we add depreciation back. Here you can see it, minus depreciation plus depreciation, it cancels each other out. Then we have the operating cash flow, the cash flow provided by operations. We subtract how much money we spend on working capital, and we subtract how much money we spend on long-term assets, capital expenditures, and we end up with the free cash flow. That's the cash that is available for all security holders, available to bondholders, to stockholders. That's the money that belongs to the investor. And we are an investor. That's why we are interested in the free cash flow. Good. I hope that makes sense. This is the first step that we have to do. This is the most difficult and the most complicated step, calculating the free cash flow. The problem is we can only do this if a balance sheet is available. So we only can do this based on historical data because, in the year 2022, we cannot look at the balance sheet of the year 2023 or 2024. We can only look at 2021 at best. And so what we have to do is we have to make an estimate about the future free cash flow based on the free cash flow in the past. And this is the next step. We have to forecast by how much the free cash flow will be growing in the future. And there are two ideas you could come up with. Let's say we are at the end of year 2022 and we calculated the free cash flow for 2021, for 2020, for 2019, 2018, and so on. What you could do is you could just take the average cash flow growth over the past 10 years and you could say, okay, you know what? I just assume in the future the cash flow will grow by the same rate it grew in the past. That is something you could do. You could also say, maybe I use not only the cash flow growth of this particular company I'm looking at, maybe I do it for the whole industry. Let's say you're an Adidas investor or a potential Adidas investor. You could say, let's not only take the cash flow growth of Adidas in the past, but let's use the whole sporting goods industry. And for mature and stable companies, I think that makes sense. And the good news is you don't even have to do it. You don't even have to calculate the growth rate based on historical data because you can just look it up in a database. Again, this is the New York University database, the Stern database. And you can see here it has growth rates for various industries, restaurant, dining, hospitals, whatever you're interested in, you can find a growth rate here. Okay, that's the idea. And that's the second step, which you can spend a lot of time with the second step if you do it yourself, or you can do it real quick if you just look up the number. Okay, the next two steps, we're done. Weighted average cost of capital, market value method for cost of equity and cost of debt. This is what we just did in the first chapter. And hopefully, you remember this from a couple of minutes ago. and this would be step 3 and step 4. Now, let's look at step 5. And to understand what we are going to do here in step 5, we can, take one step back and look at what we have obtained. From the first steps, 1 to 4, I would say, not 1 to 5 here, should be 1 to 4. We know in step 1, we have the free cash flow today. So maybe we use the most recent balance sheet, the most recent income statement. We do it at the day it is published. We calculate the free cash flow and we say, okay, this is today's free cash flow. Then for step 2, we take the expected growth rate of the free cash flow in percent. Let's call it G for growth rate, FCF for free cash flow. In step 3 and 4, we calculate the weighted average cost of capital. And now we can use something. We can use our formula for perpetuities. You might remember that. We talked about it a long time ago. A perpetuity is a cash flow that goes on forever, never ends. And we have a formula to calculate today's value of such a cash flow, either if it is constant or if it grows by a constant rate. And in this case, it grows by a constant rate. The constant rate is what we obtained in step 2. And we can use the NPV formula here, and we can say, okay, the value of a firm, we use V here, for value of the firm, is the free cash flow next year, free cash flow in time period 1. So free cash flow today times 1 plus growth rate, divided by weighted average cost of capital, our discount rate, minus growth rate. So this is the perpetuity formula. Just what we plug in. The cash flow in year 1 is the free cash flow in year 1, and the interest rate is the weighted average cost of capital, and the growth rate is the growth rate for the free cash flow. And then we have the value of the company, and we could use this value, for example, to determine, is the stock price fair? Why? The stock price, the price of all stocks, if we buy all stocks, we can buy the company. The price of all stocks should equal the value of the company. Or we could use it if no stocks are available. We could say, if we have an IPO, we go to the stock exchange for the first time. What is the value of the company? We do this, and then we divide this by the number of stocks, and then we have more or less the stock price. So this is a very, very important application. And actually you might say, is this really what people are doing in practice? And the answer is yes. Many investment banks, if you work in M&A, you do discounted cash flow modeling. If you do due diligence in an IPO process, you do this, discounted cash flow. And you might say it's simple. And the answer is, it looks simple. Applying this formula is simple. Everyone could do it. The difficult part is all the steps before. A lot of work and a lot of thought has to flow in the cash flow growth. A lot of work has to flow in calculating the free cash flow in year 1. We did, the basics of that. That's how you would do it. But if you check out the balance sheet, it has many, 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 many lines. And for every line, you have to think, does this represent a cash outflow, inflow, or is it cash neutral? No cash flow. And this work is done by many, consultants and M&A workers on a daily basis, I guess, with the goal to come up with the value of a company. All right. I hope this makes sense to you. I hope you now know why the weighted average cost of capital are so important and you know how to calculate them. And one of the applications we just learned is the firm value. And that's how we do it. All right, we will practice this also in the exercise. See you there or in the next video lecture. Take care. Bye.